Part 2, Chapter 7, and now what we're going to look at is notes receivable and factoring. Notes receivable. Notes receivable, interest accrues over time. A discounted note, the interest is deducted at the beginning, and a zero interest note, interest is implied. So now let's look at examples of this. First, let's say we have a notes receivable. It's sold for we had sales of $100,000, and in exchange we gave them a note. They gave us a notes receivable, and they promised to pay us back at the end of 6 months at 12% interest. So in this example, all we book is the notes receivable and the sales revenue. And then at the end of the year, we would accrue 5 months interest. Remember, interest is always stated at an annual amount. So we would take the $100,000 times 12% divided by 12 months times 5 months to get how much interest we would accrue at year end. And then when the actual payment was made, what we would do is book our cash, take our receivable off the books, take our interest receivable off the books, and book 1 month's interest revenue. Now what if we had the same note, but instead it was a discounted note? So in this case, what happens is our interest is deducted from the actual cash or sales revenue at the beginning of the process. So in this case, we're only going to record $94,000 in sales, and the difference is going to be interest revenue. At year end, we're going to accrue our interest, and in this case, when we accrue it, we take it out of discount on note, and then when the note is actually paid, we're going to book our cash, take the notes receivable off the book, and write our book our additional 1 month of interest. So now discounted note would equal 0, and the notes receivable would be off the books. Now let's take a look at an example of a non-interest-bearing notes receivable. In this example, on December 31st, 2018, Mike rendered services to Danny, and they accepted $50,000 down and agreed to accept one lump sum payment of $90,000 on December 31st, 2021, and there is an assumed interest rate of 12%. So now let's walk through how we would do that. First thing we have to figure out is how do we book this journal entry. So since you're getting $90,000 at the end of 3 years, you have an effective rate of 12%. You go to the present value and look up the factor for 3 years at 12% to determine the present value of a single payment. So it would be 90,000 times the factor, and we would add the 50,000, so the total amount of the services would be $114,060, and the rest would be interest. So cash would be 50, notes receivable would be 90, service revenue would be 114,060, which is how we calculated from up there, and the difference would be discount on notes receivable, and $25,940 would be the interest revenue we would earn over the 3 years. So how do we come up with a journal entry? Well, usually you want to do an amortization table, and so this is how it goes. We would put the initial amount, carrying amount of the note, which is $90,000 minus the discount, which tells us on a book we're carrying that note at $64,060. Now, when we make the payment at the end of the first year, it's going to be, to come up with how much is interest revenue we're going to book, we're going to take that $64,060 balance, which is the note minus the discount, times 12%, and that tells us how much we're going to reduce our discount on bonds account. So the next thing we're going to do is do our next payment, and in this case now our discount on bonds balance is total, the discount on bonds plus the bond is $71,747 times 12%. That tells us how much interest we're going to amortize at the end of the year. We now end up with a balance of $80,356.86, and then we do our last payment, which really what we would do is look to see what is the actual balance. This is the last year in the discount on bonds note is, and that's the number we would use. So if we were to look at this in the accounts, it would look like this. Discount on notes receivable. Notes receivable, we would have our initial balance, and remember the carrying amount on the book is always going to be the notes receivable minus the discount on notes receivable. There's our first amount we amortized, our second amount we amortized, our third amount we amortized, and our actual payment, and both accounts should be zero at the end of the 3-year period. Now also, when you use the effective rate, the interest revenue will always be different for each payment. So what do our journal entries look like? Well, at the end of the first year, since no payments being made, we're only earning interest, we would have discount on notes receivable, interest revenue. For the second year, it would be discount on notes receivable, interest revenue. And for the third year, we would show cash of 90. We would take our notes receivable off the books and then book our last year's interest revenue. Now, what if instead we had annual payments? So, same problem, but instead what we're going to do is we're going to make annual payments of $30,000 at the end of each year. And the first payment is going to be at the end of the first year. So, again, in this case, though, we're going to have to go to we're still going to use the present value table, but we're going to go to the present value of an ordinary annuity, and the reason we're using that table is because the payment is made at the end of the period. We have our factor plus our down payment, and our capitalized value of the services is $122,055. So what does our journal entry look like? It's going to be cash, notes receivable, service revenue, and discount on notes receivable. Now what I've done is done the T account so you can see how the balance changes every time we've made a payment. So again, we start with the net amount, which is our discount on notes receivable and our notes receivable. So it's $90,000 minus the $17,945. And we would show that would be our balance when we first signed the note. Now the first payment is going to be the net amount times 12%. We're going to book that. Now we have a new balance in our discount on notes, and our notes receivable has gone down to $60,000. So if we take the $60,000 minus the $92,940, we get our $50,760. Now we can book our next interest revenue and payment. So we're going to now reduce our discount on notes account by $6,084. We're going to reduce our notes receivable, and now we have our final balance, which is going to be paid off in year 3. So we're just going to take the $30,000 minus the $26,765.79, which is the balance in the account, and that tells us how much interest we're going to book, and that would zero out the accounts. So now let's look at our actual journal entries. Okay, our December 20th would look like this, and we would also book our interest revenue. Again, we book our payment plus our interest revenue. And then for our final payment, we book our final payment and our discount on notes, which is our final interest revenue that we earn. So that shows you the different ways that you can do a notes receivable with implied interest rate or a discounted rate, actually treated the same. And what you want to remember is what present value you're going to use. If you get a single lump sum at the end of the period, you're going to use a present value table. If you're getting the same payment over a number of periods, you're going to use present value of an annuity table. Depending on when the first payment is made. If it's at the end of the first period, you use your present value of ordinary annuity. If the payment is at the beginning, when you sign the note, you're going to use present value of an annuity due. Now we're going to look at factoring. So there's two ways that people can, and people use factoring when they need their cash right away. So what they're going to do is they're going to sell their accounts receivable to a collection agency, a company usually that all they do is factoring. And they will take care of the collection and you get your cash early. Now you can do this two ways. Sales without recourse. The buyer cannot ask the seller for more money if the accounts receivable are not all collected and the buyer assumes the risk of the bad debt. The accounts receivable are removed from the seller's books. The other way you can do it is sale with recourse. Under GAAP, the seller assumes the responsibility of bad debt and must record the estimated liability for bad debt. The seller still removes the accounts receivable from the books. Now, what about the international standard? The accounts receivable remains on the books of the seller and instead a liability is created for the factored amount. So now let's look at an example. Now a company transferred $100,000 of accounts receivable without recourse. The buyer remitted 85% of the factored amount. When the accounts are paid, the buyer will remit the retained amount less 3%. So in this case, they are going to get their payment once the accounts have been paid. Sometimes they collect this up front, so pay attention to that when you're doing your homework. And assume the fair value of the 15% that's going to be retained in current dollars is $11,000. So what's our journal entry going to look like? Well, first we know we're going to get $85,000 because that's $100,000 times 85%. Receivable from factor, we are assuming we're going to get $11,000 minus the service fee, which is $3,000, which means that we hope we're going to get $8,000. And then there's the difference. Then we know the total amount of the accounts receivable is $100,000. So in this case, the difference is going to be a loss on sale of receivables. Now, what if there is recourse? Same problem. Well, again, the cash is still going to be $100,000 times 85%. The receivable from factor is still going to be $8,000, but we're going to have to set up a recourse liability. Do the accounts receivable, and in that case, we have a larger loss, and in this case, it's going to be $12,000. Now, what happens? Same problem, but it's done under the international standard. Well, we're still going to get, in this case, the payment is going to be up front. The finance charge is going to be the $3,000. They're going to set up a liability for financing arrangement of $85,000. Note, under the IFRS, if there's recourse, then you treat it as a liability. And that ends this presentation, part 2 on Chapter 7. Thank you, and if you have any questions, you can always email me.